The Reserve Bank of India, RBI, is the central bank of the country, and it performs various functions such as issuing currency, regulating banks, managing foreign exchange reserves, and conducting monetary policy. As part of its operations, the RBI earns income from various sources such as interest on loans, dividends from investments, fees and commissions, and profits from foreign exchange transactions. After meeting its expenditure and making provisions for contingencies, the RBI transfers the remaining amount, known as surplus or dividend, to the Government of India. This surplus transfer helps the government in financing its fiscal deficit, which is the gap between its revenue and expenditure. The amount of surplus transferred depends on various factors such as the RBI's income, expenditure, reserves, and accounting policies. The RBI follows an accounting year of July to June and transfers the surplus to the government after its board approves it. In May 2023, the RBI board approved a surplus transfer of 87,416 rupees crore to the government for the accounting year 2022-23. This was almost 3 times higher than the previous year's transfer of 30,307 rupees crore and also higher than the government's budget estimate of 48,000 rupees crore. The increase in surplus transfer was mainly driven by higher income from foreign exchange transactions throughout the year. The RBI sold a gross $206 billion during the April-February period of FY23, up from $96 billion in the previous fiscal. The RBI earned more profits from these sales as the average historical cost of dollar purchases was around 63 rupees a unit, while the market price at which RBI sold dollars averaged 80 rupees during the year. The RBI also earned higher interest income from lending to banks through various windows as the benchmark repo rate climbed by 2.5 percentage points during the year. Moreover, the RBI adjusted its reserves as per the recommendations of the Bimal Jalan Committee, which suggested a lower level of contingency risk buffer at 6%. The surplus transfer from the RBI provides a major boost to the government's fiscal position amid slowing divestment and lower tax collections due to the pandemic. The government expects its cash position to improve after receiving the larger-than-budgeted surplus from the RBI. The government will assess how to use the additional funds for various purposes such as spending on health, infrastructure, and social welfare schemes. The surplus transfer from the RBI to the government will have a significant impact on the government's fiscal deficit and spending plans. Here are some of the possible effects. The surplus transfer will help the government reduce its fiscal deficit, which is the difference between its revenue and expenditure. The fiscal deficit for FY23 was estimated at 6.8% of GDP in the budget, but it could be lower if the government receives more income from the RBI and other sources. The surplus transfer will also boost the government's cash position, which has been strained by the COVID-19 pandemic and its economic fallout. The government can use the extra funds to meet its expenditure commitments, such as salaries, pensions, subsidies, and interest payments. The surplus transfer will also enable the government to increase its spending on various sectors, such as health, infrastructure, education, and social welfare. The government can use the additional resources to stimulate the economy and support the recovery from the pandemic. The surplus transfer will also have implications for the RBI's balance sheet and monetary policy. The RBI earns income from its foreign exchange operations, domestic securities, and lending to banks. It transfers a part of its income to the government after meeting its operational expenses and contingency reserves. The RBI has to balance its surplus transfer with its need to maintain adequate reserves for financial stability and inflation management. The surplus transfer of 87,416 rupees crore from the Reserve Bank of India, RBI, to the government for the financial year 2022-23 has several implications for inflation, interest rates, and growth in the economy. Here are some of the possible effects. The surplus transfer will boost the government's fiscal position and reduce its borrowing requirement. This will ease the pressure on the bond market and lower the yields on government securities. Lower yields will reduce the cost of borrowing for the government and other borrowers in the economy, such as corporates and households. This will support investment and consumption demand and stimulate economic growth. The surplus transfer will also increase the money supply in the economy, as the government spends the additional funds on various schemes and projects. This will raise the aggregate demand and may lead to higher inflationary pressures, especially if the supply-side constraints are not addressed. Higher inflation will erode the purchasing power of consumers and affect their welfare. The surplus transfer will also affect the monetary policy stance of the RBI, which has to balance its objectives of maintaining price stability and supporting growth. The RBI may have to tighten its policy rates or use other tools such as open market operations or cash reserve ratio to mop up excess liquidity and contain inflation expectations. Higher policy rates will increase the cost of credit and dampen economic activity. The surplus transfer will also have an impact on the exchange rate of the rupee, which depends on various factors such as interest rate differential, trade balance, capital flows and market sentiment. The surplus transfer may lead to a depreciation of the rupee, as it implies a higher fiscal deficit and a lower foreign exchange reserve. A weaker rupee will make imports more expensive and exports more competitive, affecting the trade balance and inflation. The surplus transfer will also have implications for the autonomy and credibility of the RBI, which has to maintain its operational independence from the government and follow a transparent and rule-based framework for its policy decisions. The surplus transfer may raise questions about the RBI's ability to resist political pressure and safeguard its balance sheet from fiscal dominance. The surplus transfer may also affect the expectations of market participants and investors about the future policy actions of the RBI. In conclusion, the surplus transfer from the RBI to the government for 2022 to 23 has both positive and negative implications for inflation, interest rates, and growth in the economy. The net effect will depend on how the government uses the additional funds, how the RBI responds to changing macroeconomic conditions, and how the market reacts to these developments.